and from Chairman Gensler's speech about Dodd-Frank and swaps being put into a cleared environment as well as traded on SEFs, or swap execution facility. We decided to have a panel of what I think are the leading SEF candidates. Not that there isn't others out there, but certainly ones that have spent a lot of time. They've spent a lot of time working at it and working with the CFTC, meeting the requirements thus far that have been put out to be a SEF, and these guys are very also knowledgeable of the rules and sort of the direction that Dodd-Frank and the rulemaking has gone. So I got harassed about this morning, but since I am introducing 40 people over the next day and a half, I'm going to turn the intros to each individual, and let me be more specific this time than the earlier panel. If you tell, who you are, how long you've been at the company, and a little bit about the trading platform that you operate. Sure. And I'll turn it to Lee.
Thanks, Rich. My name is Lee Oleski. I'm the CEO at TradeWeb. TradeWeb was an idea that began in 1995 and actually started trading business in 1998. I'm the CEO and co-founder of the business. Essentially, TradeWeb is a business that evolved out of the idea when the Internet was being formed that we could connect participants in the market to trade things other than widgets. So we started our business in '98, and it essentially linked up big banks providing liquidity to their large institutional customers in the U.S. Treasury market. That was something that wasn't really being done at the time. The concept was to create an auction model. There was a few other folks that were looking at the same thing at that time in '98, and we did it with the U.S. Treasury market. Over the years, we've expanded our business. Now we have offices around the world. We trade about 23 different products. There's around 600 employees. We do all our own technology. We are a private company. We've had different ownership structures over the years. Currently, we have 10 banks as investors, and Thomson Reuters is our majority investor. And we focus on fixed income and derivatives. So the world's government bond markets, that's Euro government bonds, JGBs, U.S. Treasuries, mortgages. We also do derivatives, interest rate swaps, credit default swaps, credit, a number of other products. And over the years, we've expanded our business technology, really, to be able to handle different layers of the market. So in addition to doing what we would call the institutional slice of the market, which is banks making markets for large institutions, we also do the interdealer side. And over the years, we've acquired a number of voice brokers and integrated that into an electronic model, as well as having started a retail business 3 or 4 years ago. So we have each layer of the fixed income and derivatives business. We trade about 300 billion plus per day. We have over 2,000 institutions around the world that are part of our network and about 50 banks that are providing liquidity.
And I'm Rick McVeigh, the CEO of Market Access. I was the founder of the company 12 years ago. As many of you know, we went public about 8 years ago in 2004. Similar to the TradeWeb business model, we're in the institutional customer to multi-dealer electronic trading space. Our focus has always been primarily on credit, with our primary markets in corporate bonds, emerging markets, high yield, agency debt, Euro bonds. And as it pertains to today's topic on SEFs, not surprisingly, our focus on swaps is primarily on the CDS market, where we intend to register as a SEF once the rules are finalized later this year.
Good afternoon, everybody. My name is Chris Ferreri. I'm a managing director at ICAP. ICAP was formed through the merger of two large interdealer brokers, Garban and Intercapital, in 1999. It sits at the center of the fixed income capital markets, traditionally intermediating between dealers for fixed income. Product lines range from U.S. agencies to weather derivatives, a very, very wide variety of products. On any given day, about $1.5 trillion goes through ICAP. ICAP, through a series of acquisitions, purchased BrokerTech in 2003, the Benchmark U.S. Treasury platform, U.S. repo platform, UK repo. In 2005, purchased EBS, spot foreign exchange platform. We operate about a half a dozen different trading platforms customized to about 35 different product lines. Several thousand participants worldwide. There's roughly 5,000 employees in 23 different countries around the world. Michael Spencer is the group CEO, foresaw the consolidation in the industry in the late 90s, and we are now living through the next phase of major changes in the industry, considering the implications of Dodd-Frank and the regulation of the over-the-counter derivatives market.
Yeah, good afternoon. My name is Neal Brady. I'm the co-founder and CEO of Eris Exchange. Thanks to Rich for inviting us to participate in this panel. We are not a swap execution facility. We're not a SEF. We're a designated contract market, or a DCM. We play in the SEF landscape, and we can talk about that in the discussion afterwards. We trade an interest rate swap futures contract that replicates the cash flows associated with a vanilla interest rate swap and has a lot of flexibility that an over-the-counter instrument, over-the-counter swap has. We clear the trades at the CME, and our technology is provided by, white labeled by State Street Bank, if you're familiar with the CurrentX platform or the GovX platform. We have a central limit order book, an RFQ facility, and we also support block trades. We can talk more about that later. And then just of interest for the dialogue, a month or so ago, we launched in conjunction with the CME, margin offsets against our swap futures contract against Eurodollars and Treasury futures.
Okay, so what we've talked about this afternoon was essentially a new market being created, a new market that's really non-transparent now, that's with the dealers, but will be cleared, centrally cleared, at least the standardized swaps, and they will be traded electronically on a SEF platform. So I guess to start this off, I guess the first question is, what's the time frame? What are the most important things that we're basically, I believe, waiting on the CFTC to make rules, propose and finish, finalize rules. So as I think what investors would like to know is, what are you watching? What are you looking for, key landmark rules that are coming out from the CFTC, and what are the key sort of decision points that you're going to look at as you try to prepare for this new market? Like I say, could it be trade reporting, clearing, execution rules? Those would be the first three, I guess.
That's what's on my chart here.
That's why I got it on my outline.
I'll kick it off. I think you hit there's a lot of things going on here, and this is a very complex situation. So for us, what we try to do is really just hone in on those inflection points, those moments where we think things are going to change when we have these kinds of discussions. And I think it is, when is the reporting? So that reporting is probably the first big thing to happen. Once swaps, interest rate swaps, credit default swaps are required to be reported to a central repository, and then more importantly, when that becomes a public dissemination, that'll start the ball rolling on, I think, one of the changes here in the marketplace, which is, as Rich has said and the chairman said at lunch, is this big focus on transparency. So you will have, it'll be delayed, it's going to be phased in, it's only a 30-minute, after the fact kind of thing, and it's not likely to really take hold until the fall, but that will be, in our opinion, the first point, because market participants then will be able to see, really for the first time, where trades are occurring, what's the print, what's happening. And it's not going to be incredibly specific. There's going to be some ability to disguise the true size of trades, but I think that's the first inflection point. The second is the clearing point, which is so critical to the systemic risk reduction that's part of this Dodd-Frank initiative. So that will begin phasing in all likelihood, and I'm just parroting what I heard today at lunch, later this year. And it's a sequenced type of thing, so that you have to think about it in terms of different segments of the market will have that clearing requirement at different time frames, and it's basically they're 90 days apart. So it's the big players in the market that'll be required to clear, the banks, the major swap participants. By the way, generally they're already doing that certainly in interest rate swaps and credit default swaps, so that's not a huge thing. But it's the next two phases that start to really bring in the rest of the market. So after the major swap participants come in, then you start seeing the institutions come in, one in a phase, I think it's 90 days later, and then 180 days after the start. So you're going to see these three different segments of the market really over the course of the next year or so be required to use a central counterparty in their business. And that's a big change to the model of derivative trading, which is historically in the last 20 years since it's been invented, been a large part about the counterparty risk between the two participants. So it goes from being a bilateral credit situation where you're taking a credit risk of your counterparty to eliminating that, and that's one of the big things in Dodd-Frank. And then I guess the other thing I would just raise is the sort of CEF framework, and that's the introduction to the marketplace of a requirement for derivatives activity to occur over in a regulated market, right? A la broker-dealer, and that's this whole CEF or DCM, so that activity in these derivative instruments, and there's carve-outs, and there's block rules, and there's different things, will be happening within these regulated entities that will be called CEFs. And we're not certain on all the time frames because one kind of happens after the other. The CEF rules haven't come out yet. That's sort of late summer, early fall. And the CEF implementation and the execution requirements will come after clearing. So that's kind of the three things that I wanted to highlight. And I think we actually all talked about those being three of the bigger things to look out for.
Yeah, just follow on that. I agree with Lee's comments on the sequencing of market transparency and clearing and ultimately execution, and they are all interconnected. And I think in terms of framing out two issues, one, what is the outlook for overall swap market volumes, and then secondly, where does that volume take place? There's a lot to be determined with the specifics of the rules that are going to be coming out in the next 6 months or so. At face value, I agree with Chairman Gensler's comments earlier today that transparency is good for market participation, it's good for liquidity, it should lead to a more vibrant market. Having said that, many swaps are illiquid swaps that trade infrequently, and requiring pre-trade transparency for privately negotiated, infrequently traded swaps is not necessarily healthy for the volume in that market. So we and others, I think, are actively participating to provide input to the commissions around where transparency and central trade tapes make a lot of sense to promote participation and volume, and where it may create a problem in terms of incentives for market makers to commit capital and provide markets in less liquid areas. There's a lot to be determined in terms of the specifics around trading protocols, too. I think this is a key issue. We'll learn more about that in the next quarter. It sounds like Chairman Gensler said he hopes that the CEF rules may be out as early as July, but sometime in the third quarter. We all have a vested interest in the trading protocols. The interdealer brokers can make a compelling argument that they operate voice brokerage operations today that are consistent with the principles of Dodd-Frank. Many of us primarily operate on auction-based or request for quote trading protocols, others on central limit order books. And it's not quite clear what we will all need to have to ultimately register as a CEF yet. So the required trading protocols are going to make a big determination in terms of how we all operate to get in the best position to gain market share after the requirements are implemented. So the other thing that I think is of interest is there's still discussion about whether swaps that are required to be centrally cleared are automatically made available for trading and subject to the execution requirements, or whether the commissions will have a separate step called made available for trading that would require that we all apply to the commissions for the swaps that we would like to have available on our system, and they would go through some form of vetting process to determine whether, in fact, those swaps then are subject to the execution mandate. So that's another important question. I don't think it's resolved at all yet. So quite a few moving parts here, and I think it'll be very interesting to see the rules start to emerge over the course of the next quarter.
I'd echo. I think the times are right. I think we're as close as we can be. We were here a year ago, and we were told by the end of summer rules would come out. The original CEF rules were proposed by the CFTC January 2011. Been a number of roundtables and open meetings discussing it. I think Davis Polk recently released a report that dealers have 1,900 action items to do from Dodd-Frank. We're really selfish on our side. We're focusing on execution, right? That's where we're at in putting these trades together. I think Rick raises a very good point about the notion of made available to trade. The Congress had recognized the need to create a regulated execution platform, method, facility, something that wasn't an exchange. But in doing so, they crafted many of these constructs related to an exchange. Exchanges have to list contracts, demonstrate that they're not susceptible to manipulation, a number of other hurdles. The made available to trade was seen as sort of the CEF version of listing. Clearly, CEFs, I think, would be eager to make everything available to trade if it's mandatory clearable, but that raises other issues as well. It's a very, very different structure that's being proposed. The timing for the dealers to understand their new role in the market, is it going to be a market maker model where the dealers still commit capital to do these trades? Will asset managers become market makers? I think the recognition that RFQ was a viable and successful way to serve a customer became very, very apparent early on. And, the question of is RFQ to one counterparty transparent enough? Is RFQ to more than one when you don't want to go to more than one too much? Are you protecting the consumer by letting them select who they want to go to do a trade or not? So I think Lee's timings were right. I think there are enough issues with some of these rules and some of the changes in market structure. They're going to let this drag through the summer.
Yeah, when we look at the timeline, and we really break it into two buckets, we say that we look at the market-driven, market drivers for pushing it into centralized clearing, and then eventually, standardization, and then more electronic trading. And the market driver side, I think you're already seeing the volumes being put up at CME and LCH and other entities where large asset managers and others are looking at what's going on with counterparty risk and what's happening in Europe with these impending downgrades. I think you're already seeing a market driver in that direction. On the market side, we also see the capital rules, the Basel rules, the U.S. Fed rules pushing people ultimately to hold fewer line items and ultimately probably change the way they trade in a more standardized fashion to compress their trades more frequently, or even sort of trade in a more standardized product. We see that happening already, and that will just accelerate. On the regulatory time frame, I think you heard it at lunch, and I don't have that much more to add, but we think the next 45 days, we've all been at this for a long time and a lot of studying in Washington. We think the next 45 days really could be kind of a game-changing type of moment when you get an actual timeline for that first clearing mandate. And as Chairman Gensler mentioned, this whole DCO submission process is really almost like a nitty-gritty, almost implementation of the rollout. When those come out and they sort of put back the swaps that are available to trade, that sets very specific clocks, like 90-day clocks, to get this going.
So someone sort of let this out of the bag, but we did do this panel last year. So like a good analyst, I've tried to be early. That's why we had Chairman Gensler for the last 3 years waiting for this. But from what I hear you saying now, we are 45 days, at least from more concrete answers. So that probably means more like 90 days.
And I don't think the CEF rules. None of us here believe the CEF rules will be done shortly, but getting the clearing
CFTC
process
they
rolling.
had 10 different rulemakings in June and July. and then 10 more right after that. That's a lot of work for the staff. There's a lot going on. The staff, in my experience, in speaking with them or working with them, are really overwhelmed. There's a lot happening. There's a lot of inputs back and forth from every interested party in the marketplace. And but I do think that there's something happening in November that might be important, that might have people try to get rules in sooner rather than later. So I think I think the sand is flowing through pretty quickly right now.
In fact, that was going to be my question, and I'll blend it into another question. But what could derail? Like, if we are 45 days from not 45 days from doing it, from a plan to do it, I guess. What derails it, or is there anything going to derail? What probability you'd put on it? And then, I guess to broaden this a little bit, looking farther out, how do you see, and which rules are going to tell you whether exchanges could apply to be CEFs, from what I understand. Is that correct? So what will be, do you see exchanges, if the rules are written a certain way, competing for the volume as well? And what would be the nuances in these rules to allow them to do that? And again, I know one answer is going to be exchanges want the clearing side, so they don't want to antagonize the dealers. But beyond that sort of known fact.
Those are two very different questions, Rich. What could derail the regulatory process and whether the exchanges are likely to be in the mix? But listen, it's the voting process within the commissions is a political process in and of itself. There are 5 commissioners at the CFTC. They need 3 votes to carry a vote, and they don't all agree on all things. So I think a lot of the work that's going on is getting to consensus within the commissions themselves. My guess is, Rich, if we played back the tape from a year ago, we all kind of thought that by now these rules would have been not only finalized but implemented. That 12 months from a year ago seemed like ample time to do that. The reality is
1Q. I think the date was 1Q 2012, sort of the target date back then.
So we're over on that one. But the reality is, they get into the details on these rules, and in every case, it's far more complex than I think everyone thought it might be 3 years ago, when it seemed quite simple to say, let's take the principles from the futures market and apply them to the OTC derivatives markets. And if we have a trade tape and central clearing and electronic trading, won't the world be a better place? Well, the OTC markets don't work like the futures markets, and there's a lot of idiosyncrasy and detail in there that has to be thought through carefully in the rules, and I think that's what the commissions have been grappling with. With respect to the exchanges, can they or will they be in the mix? My view is absolutely they will be. I think you'll see not only clearing but CEF entrants from all 3 major segments. You're going to see inter-dealer participants, you're going to see those of us in the institutional customer to dealer space, and you're going to see exchange offerings over time. And our view is let them all in, right? We all have different capabilities, and let the market decide which trading protocols and which platforms provide the liquidity and the functionality that they need. And we like flexibility. That's been our point to the commissions, is you don't need to be prescriptive. If these trades are taking place on regulated, open, competitive platforms that are linked into the clearinghouses and feeding the trade tapes, we're going to get the benefits that were envisioned in Dodd-Frank, and you don't need to be prescriptive about the trading rules. The market will figure the rest out. I'm not sure we're going to win on that point, but I think when you look inside all 3 segments, there will be CEF offerings from each of those segments. And I think in the most liquid swaps, there are those that would argue that there is room for a central limit order book, and CDS index swaps would be included on that list. The market itself, by the way, has made tremendous progress on electronic market making and electronic trading in the last 12 months, both in the interest rate swap market and the CDS market. Real work going on inside the dealer community in particular to be prepared to offer liquidity to their clients electronically, and more of it coming through all of our platforms. So the industry is moving. There's much more going on today, but we're still left with this uncertainty about the final rules, where nobody's quite sure what that's going to look like, and I think we'll see an unleashing of activity once there's more certainty around the rule set that we would expect to see in the next 3 or 4 months.
Yeah, just to follow up on your comment, Rick, I think it's spot on. Really, you can obsess about the precision about when these rules are going to come out, or you can just say, all right, we're going to stay focused, we're going to keep our points of advocacy, but let's look at what's happening in the market. On TradeWeb, we've done over 100,000 trades in interest rate swaps. Last year, our volume doubled in terms of trading interest rate swaps electronically. Every day in the last month, we've averaged 7.5 to 10 billion in notional amount and hundreds of trades. This is a quantum leap up in terms of customer activity, in terms of dealers' confidence in putting out prices electronically. And many of those customers, the largest customers, are already, and I think, Neal, you might have pointed out, are already starting to use central counterparties. The market is moving ahead here. This is not, the regulation is going to change things a lot, but things have already changed. And I think, those that are going to be waiting to see exactly what the nuances of the rules are going to be, far behind. I mean, I think you need to be investing in different modes of technology, different areas of the market. You need to be connecting up the customers today because customers are not waiting, banks are not waiting. You have a massive imperative in terms of credit exposures vis-a-vis counterparty risk. That's probably the number one item out there. So people want to be in central counterparties. They're moving to get that done. You've got a massive cost issue. So, whether you're a dealer providing liquidity or you're a customer, you want a more efficient mode of execution, and that means electronic trading. So, the market, the momentum is moving. I don't know what the percentages are, but the interest rate swap market is at least 10% electronic, and if you go to Europe, it's even higher. If you look at the CDS indices market, in the last year, that's gone up fivefold in terms of, and it's probably 40-50% electronic at this point in certain segments. So, markets are moving already. They're going to be ahead of the regulation, frankly. And I think once the regulation does come into play, and it's going to take a number of years really to get, all sort of out there and everything in place and all the interpretations, most of the change will likely have already occurred. And I think, by the time that last rule is effective, you cannot be running a large financial institution and say, okay, we got to get ready now. So everyone's moving. Everyone on this panel is investing heavily in the technology and the preparedness. And frankly, already for us, our derivatives business is a significant part of our business, our electronic OTC derivatives business.
I mean, just to echo what Lee said, I would say if you're looking at what's the difference in a year ago today and today, I think the clearing mandate is moving forward. I mean, and there may be some question, can it get done by the end of the year? And if you target December and you get into year end, does it push into the next quarter? But it's no longer, is it going to be a year off of where we think it's going to be? I mean, it's definitely moving along. The election cycle, helps move that along. There's a determination, and people have invested. And I think we all see it in the marketplace. People, the sell side and more advanced buy sides are making decisions and talking about capital efficiency in the back end. Can this cross margin against that? I think on the execution side, on the SEF rules, that's more complex. That's less baked. There's more controversial points to iron out that could take more time. But our view, our emerging view, is there's going to be an interesting moment there where the clearing mandate is in place. People are being forced to clear, put up margin for the first time, getting hit by Basel capital constraints, and we think that sort of the market drives towards standardization, whether that's continued in OTC swap or transference over into a futures product or some substitute. We think there's going to be a major driver towards putting more up at exchange and potentially trading electronically once that standardization comes into play, even absent the SEF rules being fully finalized.
Okay. I want to open up the questions if there is any first, but I got a couple more. Any questions?
One of those potential obstacles in getting the rules clarified and getting the mandated movement is this bifurcation in the market between the single name business and the index business. And so how do you see the SEC developing, or do they follow the CFTC? Once the rules are written, they just pile on with the single name business? Because some would argue that you really can't move the index business to mandated clearing unless you move the single name business as well.
My personal view is that, the index business is easier to clear, it's easier to price, it's more liquid electronically. The CFTC has the bigger piece of this pie, right? They have interest rate swaps, credit derivative index, foreign exchange forwards, NDS rather. So there's a whole lot of work. There's a lot of business lines that are impacted by this. Clearly, Chairman Gensler has been much more aggressive and much more active publicly in getting rules out and pushing that. It does present, dual registration for our employees. If they do a single name CDS, even if it's a single name that's a component of an index, they're now regulated by the SEC. I would hope the rules converge in some way. I think it would serve the industry better. So I think you're raising good points. I think that the index business will thrive electronically. I think it'll thrive because of clearing. I think average trade size will probably come down. You'll see more order-like activity than quote-driven activity.
Yeah, we spend a fair amount of time thinking about this because CDS is the one market that is most impacted by the dual jurisdictions between the CFTC and the SEC. And, I have to say it's kind of baffling to me, right, because the Dodd-Frank objectives are clear and consistent, and they decided for certain reasons that the single name responsibility should be with the SEC and the index with the CFTC. But the fact that the two commissions have not been able to come together on this is really frustrating. It really is, because it left unattended, there are some real issues for the CDS market, right? These markets are linked. You can create an index through a series of single names, and there are people that have relative value books that are active in index arbitrage all day long, that are an important part of the ecosystem and the liquidity in the market and the pricing in the market. And if there's a big difference in the rules or the timing and implementation of the rules, it could be disruptive in the near term for the market. And I've heard both commissions sort of justify why they don't talk to each other and why they can't do this together. And I got to tell you, I'm not sure it holds water. The reality for all of us is that we're not only building two different sets of trading protocols, because the rule proposals are very different. One, for a market that operates the same today. So we're building one set of trading protocols for single name CDS contracts and another for index. Worse yet, we're getting ready to register with both commissions for the same product. So how that passes the cost-benefit smell test for regulation, I don't know. And I have to say, though, we appear to have lost the argument, right? I don't think that there's any likelihood that they're going to suddenly converge in the next 6 months. And everything you're hearing today about the timetable has all to do with the CFTC and not the SEC, because they've been silent on the issue. And if I had to guess, they're going to wait and see what the CFTC rule set looks like and how the market adjusts to those rules. And because it's a smaller part of what they do overall, and the single name market is a small part of the overall derivatives landscape, they're going to take their time and come out with their set of rules sometime very late in this year or early next year, probably after the elections. So I hope that the two commissions can at least manage the timing on important things like margin, so that positions that are in the industry today that may have very little aggregate risk do not get bifurcated in a way that makes them capital inefficient to operate, which in the end, if they allowed that to happen, would be disruptive for the CDS market.
I guess just for the benefit of the audience here, and correct me if I'm wrong on this, the SEC has been tasked or mandated with the writing the rules for the security-based swaps, which includes the single names. The CFTC is all the index swaps, as well as well,
Everything else.
Everything else, basically. Rick at Market Access is probably a little bit more sensitive to the bifurcation here because he is more focused on CDS, and that's where there is the divide. But would you agree, at least from my standpoint, yes, the CFTC has been well more aggressive, transparent. Just appears like the SEC has more on their plate right at this point.
I mean, to the credit of the effort by the CFTC, it's a very small agency when compared to the SEC. I think the budget is $200 million versus $1.4 billion, something like that, for the SEC. So it's a significantly smaller agency that's been charged with regulating the futures exchanges in the past. So that's it is a big effort. One of the things that I don't think people really focus on a lot is the environment that these rules are being written in. We've been in a stagnant, I'll say stagnant because I was a Treasury broker for 15 years, a stagnant interest rate environment. Do we think that when rates go to 3, 4, 5, 6, 7, 8% in the future, you'll see 1 basis point markets on interest rate swaps in that marketplace? So we're going to rely on dealers to put their capital at risk to do an interest rate swap when prime is 19% again. These are very difficult questions, and the industry has managed to work through these very difficult times, based on the ability for markets to compete. So as these rules are being written, I think those are considerations as well that the agencies are going through. How do these rules weather the next storm as well? Do we harm liquidity? I know there are people out there that think too much liquidity is bad. What's the right balance of liquidity? But I think if I had to be given the choice of too much or too little, I'd probably lean towards too much.
I have another question, but if there's any questions from outside. So I'm a hard-headed guy. Okay. I don't have to go through my hard-headed guy.
We don't want your question, Rich, but since you asked, you can.
Go ahead.
Thanks. What's the potential that trading volumes for all these for all the swaps and things like that move not to the CEFs but to the exchanges as people substitute futures or something else for swaps? Thank you.
Yeah, or vice versa.
Yeah.
Could you list a listed like product?
I think it's dangerous to think about this as a two-sided scale, right? I don't think it's okay. It goes from over here to over here. I think it's much more of a, historically at least, it's been much more of a symbiotic relationship. So the growth in the derivatives markets, OTC, has fueled the growth in the complexes on the futures exchanges. I think there's no doubt that those two things have been linked. And I think the biggest danger here is that we, because of the capital rule changes, because of the Volcker rule, a bunch of other things, really we end up freezing out liquidity and the ability to make markets. And I think the impact of that is the thing to keep your eye on, because ultimately the system needs some grease, and I think they actually sink and swim together. I think if you see volumes go down on exchanges, it's going to mean something's going on in the OTC space and vice versa. Otherwise, we're going to have a bunch of different, I think, large complexes competing for this space, because this is very technology intensive. It's about your network. You need to have a very large connected network to make these things work. It's about your expertise in the space. And there's a group of a half a dozen or a dozen participants around the world that have a bunch of those different characteristics, and some of them will be exchanges, some will be IDBs, some of them we're both. We're an IDB. We're also in the institutional space at TradeWeb. Those will be the competitors. Ultimately, if we get the balance right, so the costs don't go through the roof and the capital charges don't go through the roof, I actually think it'll be good for both sides. I think you'll see more electronic activity in an environment where you take out the credit angle, you've got a central counterparty, the right margining, you could see a real boost because you've got more transparency. And investors ultimately want to have that transparency to be able to get in and out of positions. I mean, that's a big part of what the trading is, get in and out of those positions with as little friction as possible, as low cost as possible. So if we get those things right, I think eventually when we get out of this regulatory phase in 2 or 3 years, you're actually going to see volumes go up on both fronts.
I mean, operating as an exchange, and we certainly would be believers in that thesis that people are going to move volume on exchange. I think you already, but to Lee's point, there is definitely a complementary relationship between OTC, and there will be an OTC cleared and exchange-driven markets. I mean, I think you clearly see even today people switching out into futures or even to cash treasuries. Just looking forward, saying if this becomes so painful and the costs become so great, certainly people will think about substitutes. I think where we see the market going, the sort of more important thing for market development is, when you look at the size of the OTC market, and people always talk about how many X times is larger than futures. We always have to remember that, in OTC, you put one risk on, you put another line in, it basically offsets that risk, but you've increased the notional value. So you just have lots of line item proliferation. You have very large notional amounts. We think that, for sure, in the new world will go away because of the capital charges from Basel and from Dodd-Frank and maintenance fees that clearinghouses are going to charge and clearing firms are going to pass on. That's going to become unsustainable. So what you will definitely have, and the liquid points in the curve, I mean, certainly the more customized stuff will stay and stay more voice brokered and RFQ'd and different modes of execution. But you have a whole chunk of business that will move to more standardized exchange-type trading, whether that happens on an exchange or on a CEF. It certainly lends itself more to central limit order book trading. And then the positive side of that story is once you get through this transition, which we all hope isn't too painful, too costly, we believe then you'll get more participants in the market because it's cleared, and the turnover will go up. So you have a decreasing notional outstanding, at least in interest rate space, but then much greater turnover and higher volumes.
Yes. Could you address from your perspectives how important it is that, or how important the developments on the regulatory front in Europe are for all these markets, and just where you perceive Europe is at, or at the various countries in Europe, if that's the way to state it, versus the U.S.?
I'll take a shot at it. It seems as though the strength of the regulations seemed to wane as the sun moved east. We were the first, Dodd-Frank was the first set of legislation that came out, some very strict rules about execution methods. Europe didn't take a strong view on execution methods. They've proposed organized trading facilities. The MAS in Singapore said, we don't care how it's executed. I think the people out there that think an administration change removes Dodd-Frank, I don't think that's the case. This is a global initiative. This is not just Dodd-Frank. You may see changes in some of the rules that are applied, maybe some move towards a more a less prescriptive set of rules from the regulators, more principles-based rules. But I do think the things that are going to impact it a lot are the capital requirements, and the very structure of the firms putting these trades on. And I wouldn't discount what's happening in Europe right now as having an impact. Problems are not solved; they're being dealt with, and I think that these are going to have an impact on how quickly these rules are finalized. They're busy doing other stuff too.
Is it a problem for the market participants if the U.S. regulators and the U.S. domiciled companies are starting to do things this fall and early next year, and the European counterparts or arms of those same firms are operating with a different set of rules?
Yes.
Yes.
Well, I'll just for a sec. I'll take the other side of that because, there's an impact, but there's differences. I ran our business in Europe for 10 years. There's differences in different jurisdictions, in rules and ways of doing business and the cost of doing business. Those differences are always going to exist. Cultural differences, rule differences. Generally speaking, I think Europe is, on some of the bigger issues, closer aligned than people maybe realize. Clearing, capital rules. I guess if the capital rules diverge, we got a big issue. If the clearing diverges wildly, we got a big issue. Things like execution, a little bit. There's a huge base of our customers here in the U.S. We have 2,000 institutions. They can't just start doing business in Europe. They're going to have to do business here. Their asset managers, their pension funds, et cetera, they're going to need to do business here. And I think there's going to be, and there's the same thing in Europe. There's a bunch of Europe domiciled entities that are going to have to do business in Europe. And, I think that often we overstate okay, we're going to go crazy with regulation here, everything's going to move overseas. I think you can overstate that argument. Yes, some business will move, but which business is it that's going to move? And it really gets down to how much of a real difference is there in each of the jurisdictions. As I said, we started our business in the U.S., then we built it in Europe. It's slightly different, but the technology is the same, the architecture is the same. It's not that vastly different, even though it's a different regulatory environment, different cultural environment, et cetera, et cetera. So I think it can be overstated that, we're getting way out of sync.
Okay, so just to wrap up here, I was going to go back to my hard-headed story. I'm a hard-headed guy. I'm going to keep doing this panel until one of you is bigger than the CME or you're smaller than Revco. So I guess the point is,
wow.
If we...
we were wrong last year you brought us back.
I'm not sure that the shareholders in this room want us all running our businesses that way, Rich, but I could be wrong, but that sounds awfully binary to me.
No, we hope it's not that binary, but I guess let's try to get, if we can get some future view, and we're limited on time here, but if I can get 1 minute on if we come back here next year, what's the world going to look like? I think everybody's clamoring to try to pull something investable or to get at least what your views are, and not that they're going to be right, not that the rules are written, but just some view of what the world looks like next year, and something I can harass you with next year to say, hey, you were dead right or dead wrong. But very short if we could.
Well, I'm not going to come back if I was wrong. I would say...
you have that luxury as a private company.
That's right. You know what? I do think, we will know by next year to a large extent who some of the winners and losers are going to be over the next 5 years. Because I believe this is an inflection period over the next year. And I can tell you, as I said, our volumes have doubled and keep going. And if by next year, the rules are roughly in place, we're going to see a lot more of the business go electronic. And wherever it goes, it's likely to reside and grow because the liquidity tends to be very sticky, the network's sticky, and I think, for sure, you're going to sort of start to see the field narrow. I think there's going to be a lot of capital thrown at this because there's a lot of opportunity when you're right before this inflection point. But by a year from now, I think a lot more of the business in the derivative space, OTC derivatives, is going to be done through electronic platforms, whether there's CEFs or not.
Yeah, I'm optimistic that a year from now we'll see a very sensible framework for the new market structure in liquid swaps. The 10% of swaps that make up 75 or 80% of today's volume. I think there's broad agreement on where we need to go with transparency rules for liquid swaps, for central clearing, and for new methods of execution, whether it's exchanges or CEFs. And I think that's the right sequence. I think we can learn a lot of lessons from that shift in market structure on the liquid swaps. If there's some logic to why the SEC may be slightly behind the CFTC is because the swaps that they are responsible for are less liquid than the ones that the CFTC is most focused on, whether it's CDS indices or interest rate swaps. So I think the infrastructure and the new market structure will be in place for the liquid market. And we will be working on the next steps in terms of sensible changes around the less liquid swaps.
I think a year from now, CEFs will be up and running. I think there will be CEF trading. There'll be a vast majority of these swaps will be centrally cleared. I'm somewhat concerned about the notion that once the regulators know where all these trades are, we're safer. I think you have to know how to analyze those trades, how to analyze that data. I think that's a significant hurdle, and we're looking at how can you approach this mountain of data that's generated every day. I think someone said it's a terabyte of data a day created by the markets, and the regulators are going to have some pretty sophisticated systemic algorithms to look at this and see where these trades are happening. What constructs are being put together. So I think a year from now, CEF trading organized execution venues. I think that we'll be talking about now what do we do with the data.
I think a year from now, in this multi-year Dodd-Frank journey that we've all been under, I think it'll be the first time we're sitting down really talking about the market forces driving business and market dynamics. I think you'll have a major body of these rules, the clearing stuff and the clearing mandates behind you, and we'll be talking about what is that doing to customer behavior to drive to various platforms and various facilities. I'm not so sure the SEFs are going to be able to work through all of the details. There's a lot of operational details, credit controls, and interconnectivity of multiple SEFs to multiple clearinghouses. I think we'll be right in the midst of still ironing through a lot of that up and running, but a lot of sort of implementation of stuff still to go. A year away. I know we've got plenty of time. Let's get going.
Anyway, that's it. Well, you heard it. So next year, now I hope Chairman Gensler makes it through next year as well, so he can be here for this.
He can come if he's not chairman.
He absolutely can.
That wasn't so clear in your last question to him today, Rich, at lunchtime. I'm not so sure.
Anyway, I want to thank these guys. It appears, and we said this last year, but it does appear like we're on the verge of some regulatory changes that's going to bring this more in focus. For these guys, it's been like playing a game with the rules not defined and the boundaries not defined. It looks like we're getting closer. So these are players that you do want to watch, when it does happen, and we'll certainly have you back next year to see whether you're right or wrong, no matter what happens. Like I said, I am hard-headed. We're going to get this right over time. So with that, thank you, and we'll take next speaker at 3:30. So we've got like 6 minutes.